Have you ever wondered what caused the bubble economy in Japan? Let's start from the beginning, with the Plaza Accord in 1985. The Plaza Accord was an agreement between the United States, Japan, West Germany, France, and the United Kingdom to address trade imbalances. The primary aim was to devalue the US dollar against the Japanese yen and the German Deutsche Mark. As the yen appreciated significantly against the dollar, Japanese exports became less competitive, leading to a slowdown in economic growth. This was a tough blow for Japan, a country heavily reliant on its export sector. To counteract this slowdown and stimulate the economy, the Bank of Japan made a move that would set the stage for the bubble economy. They lowered interest rates, causing a surge of cheap money to flood the economy. So, to counter the economic slowdown, the Bank of Japan lowered interest rates, leading to a flood of cheap money. The second cause was the financial liberalization during the 1980s. A wave of deregulation swept across Japan, toppling the previously strict regulations on lending. This was a seismic shift in the financial landscape. Banks and financial institutions found themselves unshackled, with a newfound freedom to extend credit. And extend credit they did. This led to a significant increase in risky loans, particularly those directed towards real estate and stock investments. The result was a financial environment akin to the Wild West, where rules were scarce and risk-taking was the order of the day. This flood of credit, combined with the low interest rates, created a potent mix that fueled speculation across different asset classes. It was this speculation that would, in time, lead to the creation of the bubble economy. This deregulation led to an increase in risky loans and fueled speculation across different asset classes. The third cause was the stock and real estate mania. An abundance of cheap credit flooded the market, thanks to the Bank of Japan's extremely low interest rates. This, coupled with an unshakable optimism about Japan's economic future, ignited a frenzy in the stock and real estate markets. Prices of land and stocks began to climb to dizzying heights. But that wasn't all. As prices rose, a feedback loop was set into motion. Investors, convinced that further price increases were all but guaranteed, began to borrow even more. This additional borrowing then fueled further price increases. It was a classic case of speculation where perceived future value justified the borrowing and buying of today. However, this was not a sustainable model. The cycle of rising prices and increased borrowing was a runaway train destined to crash, and crash it did. This resulted in an unsustainable cycle of rising prices and increased borrowing. The final causes were distortions in the tax system and the myth of ever-rising land prices. Certain tax policies inadvertently fueled the fire of speculation. These policies were skewed in such a way that they encouraged excessive, debt-fueled investment, particularly in the realm of real estate. This was the breeding ground for risky financial maneuvers, as investors were essentially incentivized to borrow and buy. Now let's talk about the so-called myth of ever-rising land prices. A dangerous optimism and complacency took hold, with the belief firmly rooted that land prices in Japan would never decline. Limited space and predicted economic growth backed this illusion. This belief was not only misguided, but it also perpetuated risky investments in the real estate sector. The myth, combined with the distorted tax policies, created the perfect storm. So these were the main causes that led to the bubble economy in Japan. To recap, the causes of the bubble economy in Japan can be traced back to a series of interconnected events. The Plaza Accord sparked a chain reaction, leading to financial liberalization, and in turn, a stock and real estate mania. Distortions in the tax system further fueled this frenzy, and the myth of ever-rising land prices sealed the deal. Understanding these causes helps us comprehend the complexity of economic bubbles and hopefully avoid similar situations in the future.